Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Working Capital Management, strategies to keep your business financially healthy. Streamlining accounts receivable. Accounts receivable is money you're owed, but the longer it takes to collect, the tighter your cash flow feels. Speeding up collections can ease the pinch. Here's how to make it happen. Set clear payment terms. Keep terms simple, like net 30 days. Make sure customers know and agree to them upfront. Send invoices immediately, don't wait. The faster you send invoices, the sooner customers can pay. Offer early payment discounts. Incentivize customers to pay quickly. A 2% discount for paying within 10 days can work wonders. Follow up on late payments. A polite reminder email or call can nudge delinquent customers to settle their accounts. Use digital payment options. Make it easy for customers to pay online. Remove any barriers to getting paid. Think of receivables as fuel for your business. The sooner you collect, the faster you can move forward. Managing accounts payable. On the flip side, accounts payable, your bills, must be managed thoughtfully. Payers who hold on to cash longest often win the working capital race. Here's how to handle payables strategically. Negotiate extended payment terms. Many suppliers are open to longer terms, giving you more breathing room. Avoid early payments unless incentivized. Keep cash in your account until the due date, unless a discount is offered. Consolidate payments. Align due dates where possible to streamline cash outflows. Build strong supplier relationships. Suppliers may offer flexible terms to businesses they trust. A good relationship can be a lifeline during tight periods. Use electronic payments. E-payments save time and ensure you hit deadlines without unnecessary penalties. Managing payables well can feel like a juggling act, but with the right rhythm, it ensures your business stays agile without losing trust from your vendors. Working capital management boils down to keeping the financial system of your business fluid. By optimizing inventory, speeding up receivables, and smartly handling payables, you give your business the cash and confidence it needs for success. Working capital metrics and analysis. When it comes to managing your business's working capital, metrics are your compass. They help assess financial health, measure efficiency, and pinpoint areas needing improvement. Understanding these key indicators ensures you're equipped to make informed decisions. Let's break down 3 critical metrics that every business owner should monitor closely. Current ratio. The current ratio measures your ability to cover short-term obligations with short-term assets. Essentially, it's a quick snapshot of your liquidity. Formula. Current ratio equals current assets divided by current liabilities. Why does it matter? A current ratio above 1 indicates that your company can meet its short-term debts with assets on hand, a sign of good financial health. For example, if your ratio is 1.5, you have $1.50 in assets for every $1 owed. However, a ratio too high could mean you're not using your resources efficiently, money tied up in excess inventory instead of driving growth. This metric is like a safety check. Do you have enough cushion to handle the day-to-day? Keeping an eye on it ensures smooth operations without risk of a liquidity crunch. Quick ratio. The quick ratio takes the current ratio a step further by stripping out less liquid assets like inventory. Why? Some assets, like inventory, may take longer to convert into cash in a pinch. This makes the quick ratio a more focused measure of short-term liquidity. Formula. Quick ratio equals current assets inventory divided by current liabilities. Some call this the acid test ratio because it reveals your true financial strength during tough times. A quick ratio greater than 1 suggests you're in good shape to handle sudden expenses. For example, if a key customer delays payment by 30 days, the quick ratio helps you gauge whether you can still meet payroll and bills without borrowing. Think of it like your business's fire extinguisher. It's not something you use daily, but during emergencies, it ensures you're ready for anything. Cash conversion cycle. The cash conversion cycle, CCC, shows how long it takes to turn investments in inventory and receivables into cash. It connects how you manage inventory, collect receivables, and pay suppliers. Formula: CCC equals days inventory outstanding, DO, plus days sales outstanding, DSO, days payable outstanding, DPO. Days inventory outstanding, DO, how many days it takes to sell your inventory. Faster sales mean cash comes in sooner. Days sales outstanding, DSO, the average time it takes to collect payment from customers. Shorter DSO means quicker cash inflows. Days payable outstanding, DPO, how many days you can delay paying suppliers. Longer DPO means you hold on to cash longer. A shorter CCC means you're efficiently cycling cash through your business. For example, decreasing DSO ensures you get paid faster, while optimizing DO limits cash tied up in inventory. If your CCC is too long, you might struggle to cover operating expenses, leading to cash flow issues. Think of the CCC as the speedometer for your working capital. The faster your cycle, the smoother your cash flow, allowing your business to accelerate growth without stalling out. By analyzing these metrics regularly, you'll gain clarity on how well your working capital is managed. This insight empowers you to address inefficiencies and keep your business financially strong. Challenges in working capital management. Managing working capital isn't always straightforward. It requires balancing assets and liabilities while staying prepared for unexpected scenarios. Businesses often encounter issues that disrupt cash flow or strain financial resources. Below, we'll explore some common challenges and how they impact working capital management. Seasonal fluctuations. Seasonal changes can throw working capital needs off balance. Demand often spikes or dips at certain times of the year, which can make planning difficult. For example, a retail business might need additional cash to stock inventory before the holiday season, but once the season ends, unsold goods could tie up funds. Conversely, service-based businesses may experience slower months during off-peak periods, reducing incoming cash while regular expenses continue. How does this affect working capital? During high-demand periods, businesses may need to purchase inventory upfront, increasing liabilities before revenue catches up. During slow seasons, steady overhead costs can drain cash if incoming payments are delayed. A lack of preparation for seasonal changes can feel like riding a financial roller coaster. Businesses must plan ahead with cash reserves or short-term financing options to smooth out these fluctuations. Economic conditions. Wider economic trends can have a big impact. Booms and busts in the economy influence customer behavior, cash flow, and even access to credit. In a booming economy, businesses might see rising demand, but this often comes with increased costs, more inventory, larger payrolls, and higher marketing expenses. If working capital isn't managed carefully, rapid growth can lead to cash shortages, even as sales rise. During an economic downturn, the challenges amplify. Customers may delay payments or cancel orders, affecting cash inflow. Suppliers may tighten credit terms, forcing businesses to pay bills sooner. Access to loans or lines of credit might shrink as lenders become more cautious. Economic uncertainty can feel like walking on shifting ground. Businesses need to monitor their cash flow closely and stay flexible enough to adjust quickly to changing conditions. Supply chain disruptions. A hiccup in the supply chain can cascade into working capital problems. Supply chain disruptions, caused by delays, shortages, or price increases, directly affect cash flow and stock management. For instance, a delay in receiving inventory slows down production or sales, leaving businesses without revenue to cover expenses. Price hikes from suppliers increase costs, reducing profit margins or forcing businesses to dip into reserves. Large upfront payments to secure goods during shortages tie up valuable working capital. Imagine a restaurant receiving late deliveries from its supplier. Without ingredients, it can't serve customers, leading to lost revenue while overhead costs continue to climb. The global nature of supply chains makes this a widespread issue, especially during times of crisis, like natural disasters or geopolitical conflicts. Businesses must build financial buffers and explore alternative suppliers to minimize the impact of disruptions. By addressing these challenges head-on, businesses can strengthen their working capital strategies and ensure smoother day-to-day operations. Without a plan, Even a small issue can snowball into much bigger financial problems. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.